All right, just a quick one before we get going. So please don't take anything you hear in today's episode as financial advice. Please speak to a trained professional if you do wish to participate in markets. Crypto is inherently risky and you will lose all your money, particularly if you listen to us for financial direction. So enough of that. Please give us a like, subscribe, enjoy the show, and see you next time.
Welcome back. We're back with Dion from Term Labs. This is an interesting one, guys. Interest rates, fixed interest rates on your loans in DeFi. Dion, give us a brief introduction on yourself and what it is that you guys have done. We'll get into the details of what it is that you guys have done, but from Harvard law graduate to DeFi DJ and to founder, tell us a bit about yourself and welcome. It's great to have you with us today.
No, thanks, Jedi. I really appreciate the opportunity to be here and speak to the community. Quick background on myself. Started my career in TradFi at a hedge fund in New York. Spent a couple years there, but was interested in public policy, so decided to move down to DC, join the Federal Reserve Board of Governors. Was there from '07 to '09, so bracketing the financial crisis. Actually, as a part of it, did some work behind the first round of quantitative easing. So it's definitely an interesting time to be at the Fed, which is otherwise a pretty sleepy institution. But after 2 years, through my exposure in DC, decided to get a law degree. Ultimately, graduating from Harvard Law in 2012, but knew pretty early on in the law school career that I didn't want to practice law. So decided to come back to Wall Street. Started a career as a government bond trader, trading U.S. government bonds both on the sell side and then on the buy side. Then a few years ago, decided to strike out on my own, started a small family office, investing in various multi-strategy. But as part of that process, discovered DeFi. So this is back when, I don't know if people remember, but interest rates were zero, kind of post-COVID. And DeFi rates, even on Aave were like double digits.
Yeah.
So it's like, all right, I got to go check this out, see what's going on with this DeFi thing. And as part of that journey, started to fall into various advisory roles. And one of those roles was serving as a DAO treasury manager, managing DAO treasury of operational capital. It was actually in this role where I started to notice, some market gaps in the DeFi space. So, it's very difficult to budget or forecast for DAO treasury if you don't know what interest rate you're going to end up earning. And the flip side, it's very hard to borrow if you don't have a way of locking in your cost of financing. So as a fixed income guy, naturally, I sat down to kind of take a crack at this problem. And ultimately, what we came up with was term finance. I think the key difference from other protocols that have tried to do fixed rates in the past is that we'd recognize that matching large volumes of fixed rates is very difficult to do in some sort of continuous order book. You might post an offer and it'll sit there for days and nothing might trade. And that's not a great user experience. And on the flip side, using some sort of DEX means that you need capital providers beyond the lender and borrower. You need a third party to deposit idle capital in a DEX. And because fixed rates don't move very much, you're not earning a lot of transaction fees. It doesn't make sense. It's too capital intensive. So the solution we came up with was to use an auction process, a weekly auction, to match borrowers and lenders. And yeah, the rest is history.
How long have you guys been kind of like out in the wild for? It's been quite a bit of time now.
Yeah, it has. So we raised our seed round in January of last year, 2023.
Okay.
Rolled out our testnet around April, May.
Mm.
Ran the testnet for about 2-3 months, then a private beta towards middle summer, and ultimately went live on public mainnet in August of 23.
Okay, so I mean, you guys effectively like the mouthful is non-custodial fixed rate collateralized lending in crypto. Break that down for us in terms of what it is that you guys are doing essentially on the front end to start off with, and then what is actually going on under the hood in order to achieve that string of quite complex dynamics. Non-custodial fixed rate collateralized lending.
Yeah, sure. So I think a lot of users might be familiar with Aave. So like Aave, all loans on term are over collateralized, and the collateral sits in smart contracts. So nobody holds your collateral, it's a smart contract that holds the collateral. The key difference between term loans and Aave loans are that Aave enables variable rate markets. So the interest rate that a lender receives and a borrower pays varies over time. Whereas on term, the interest rate is fixed and the loan is outstanding for a fixed period of time. In terms of the user flow, we have these weekly auctions. And while it sounds complicated, it's actually quite straightforward. If you want to lend, all you need to do is submit the amount that you want to lend and the minimum interest rate that you would need to receive in order to be willing to make that loan. And on the flip side, if you want to borrow, you deposit your collateral, specify the amount that you want to borrow, and the maximum rate that you would pay in order to take out a loan. And that's it. You just sit, you wait, single click transaction. Once the auction closes, you'll find out whether or not you won or not.
So in terms of, say, what prevents me from going and putting in an interest rate of 25% for argument's sake, and 20 of my friends do the same thing, and we all decide, listen, let's go and kind of like fix this auction and kind of set it at 25%, and then it gets accepted. Is that possible? But then kind of like logic says then no one's going to borrow at that rate anyway, so it's kind of like a pointless exercise. But just on the first side, on the first part of that, is it possible to do something like that within the mechanism that you guys have got at the moment?
Yeah, so lenders can submit any rate, any
Yeah.
minimum interest rate. Borrowers can submit any rate as well. They can say I'll pay 0 if they want.
Yeah.
If you try to lend at 25%, most likely you're not going to get filled.
Okay.
Now you could be both sides and try to fix it at 25. But then nobody's really making any money. You're just paying yourself.
Yeah.
So
Okay.
ends up being moot.
So in terms of like the week auction, so do you have constant flow of auctions that are happening throughout kind of like the calendar month? So you're having 4 auctions every month, right? And then during that period, if the interest rate changes, if I took out a loan at say 3%, and then the next auction gives us a loan at, or a rate at 3.5%, does the original loan still stay at the 3% rate that it was received, or does it become a variable dynamic within that?
No, the original loan stays at the original 3%.
Okay, so you're not, so in terms of, so there's no variability in terms of the loan that you take out originally, and in terms of the period that the loan lasts for, how do you guys determine that?
So we have standard. We typically stick to 4 weeks, 8 weeks, 13 weeks,
Okay.
26 out to a year. So,
Okay.
yeah. In terms of the auction dates, we try to make it predictable. So they're always on Wednesdays and Thursdays. So people have some expectation of when are these going to happen. So it's not kind of random, ad hoc.
Okay. So, I mean, I've got to ask you this question. I know that it's quite obvious, but I think it's quite important to understand, like, why are you guys doing this? Why not just keep it at variable interest rates the way that it is on Aave? It seems to have worked really well for as long as it's worked. Why are we at this juncture now essentially looking at this kind of scenario?
Yeah, no, I think that Aave is great. And in any mature market, you are going to always have variable rates. In TradFi, you have variable rates, and it serves a purpose. Primarily, it gives you liquidity. If you want to be able to borrow and repay or lend and call back your loan
Yeah,
at will, then it has to be variable because you can't guarantee any supply or demand. But that does make it very difficult, as I mentioned before, for a borrower because they don't know exactly what they're going to end up paying. And so it's hard to make any long term commitments if it's possible for the borrow rate to shoot up from 5 to 10% and stay there.
yeah,
So this allows people to plan ahead, or if you have known liabilities coming down the pipeline, you can kind of manage the time aspect of your financial balance sheet or your portfolio. So I think that's the key unlock of having fixed rates. So we do think that Aave is great and it should definitely, I think it will continue to succeed. But
yeah,
if you look at TradFi, this type of collateralized borrowing, you'll see that the variable rate and fixed rate counterparts in repo borrowing, the fixed rate counterparts actually slightly larger. They're about equal, but the fixed rate is actually slightly larger than the variable rate market. So we think this market has a potential to grow and the protocol to be at least as large as Aave if we take TradFi as a proxy for what might happen in DeFi.
Okay, so I want to better understand kind of like the significance of what it is that you guys are doing by asking the question around kind of like when you guys go out into DeFi and you obviously doing the business development side of things, what kind of partnerships and what kind of product are you essentially selling, protocols or DAOs or individuals beyond just kind of like the fixed rate? How does the business development side of your business look like in a practical sense?
Yeah, so from our side, we're primarily providing a platform. Um, and all of this, especially even auctions, it's a coordination mechanism,
Yes.
right? So the problem I mentioned before with order books, you might post an order at 7 a.m. on a Sunday. The borrower might not show up until the next Thursday. And in between, there's this time gap, and it kind of causes everything to break apart because you can't find a reliable transaction. So the platform is a place where people can come and meet borrowers and lenders. And the auction mechanism also coordinates a time, which is why it's important that we always schedule at weekly intervals at predictable times, Wednesdays and Thursdays.
Yeah.
So the whole process of an auction is really a coordination mechanism. And what we're trying to do is to provide this platform where the borrowers and lenders can come and transact at size. So the BDF, or part of it, is just making sure people are aware that this platform exists.
Yeah.
Trying to bootstrap both sides of the markets. We need to find borrowers, then we need to find lenders, and then make sure they're both aware of the times and they're able to come and meet and see if there's any trade or transaction that can happen. So part of that is also awareness, just letting people know that term exists.
Yeah.
How and when these auctions are going to occur, and then get everybody to show up at a certain
Yeah.
time
So
of the week.
make makes sense. I mean, it's kind of like if you do have a treasury and you are trying to obviously borrow or even lend and get the benefit of that, this would be a really good solution from that perspective, from my understanding of what it is that you just told me. It makes complete sense. Just one of the challenges that I saw kind of come up around kind of like interrogating what it is that you guys are doing is that I almost get the feeling that there's this process where like everything works great, the platform's there, it does what it's supposed to, but it's almost like it's an isolated thing. And I was just trying to figure out, is there significance or potential significance around kind of these fixed interest rates in the greater DeFi community? Like, do we have a scenario where term then becomes almost like the go-to for interest rates at some point in time, beyond just participating in the auction? It's kind of like, well, we've got a good idea in terms of what the market is doing. Term's done several $billion over the last however long, and we've got an indication that interest rates are sitting in this range. Is there a way to scale what it is that you guys are doing beyond just sentiment and kind of like formalize this and not make it almost fragmented, and like have a greater kind of understanding around interest rates of the platform? Or do you think that it becomes confined only to the platform itself?
Yeah, that's a great question. So the platform itself serves a purpose of price discovery. So through these auctions, you have large players clearing large amounts of volume. You get a good read on where the market roughly sits around the time of the auction in terms of interest rates across various terms. What comes out of these auctions for the lenders are ERC20 receipt tokens. So kind of like a PT token for people who are familiar with Pendle. It's a token that can be redeemable for an underlying token at a certain date. So these ERC20s are fully composable in DeFi. They can move around different wallets, different protocols. So a lot of interesting protocols right now are already coming up to allow for secondary market trading of these types of fixed rate tokens. Hourglass, for example, they're using the Seaport technology as a settlement layer and create an order book around these. And if you go now, you'll actually see term repo tokens are listed on Hourglass. You have RFQ platforms where these tokens can trade. So I think the key thing is that once you have a large supply of these tokens with various maturity dates, what you're able to do is start to see, live markets, live interest rates based on these tokens that have previously been minted through the auction process. So the auction process is just the beginning. Once the ERC20s enter into DeFi, they can move around, there'll be markets, they'll trade, and that could then serve as live view on where interest rates are. And this is particularly important because in DeFi, one of the biggest problems is you don't have a way of pricing what is the time value of money in DeFi. And why do we need this? Why do we care, right? You say, well, it doesn't matter. But it does matter to hedge, like we said. So if you want to do options trading in DeFi or in crypto, part of that option is a time element. The option expires on a certain date in the future. And how does somebody who's a market maker or a DEX hedge out that interest rate risk? Right? Interest rates might shoot up, they might fall.
Yeah.
And it's very hard to price it if you don't have a way of hedging that. And with these repo tokens that come out of these auctions, now you have an actual spot asset that can be used to hedge that risk. And this really enables derivatives, options, and a whole, financial stack where fixed rates are, sort of a prerequisite or base building block.
I have to ask you a question around options themselves, just kind of like veering off to the left or the right, depending on which side. Why do you think that options, kind of just in their kind of purest form, have not really taken off in the DeFi context? We know that futures do really well. Derivatives have done extremely well, probably the most used out of everything. Yet options kind of like remain an outlier, even though in TradFi, we know that options are probably the most practiced out of everything. Why the disparity? Is it because we're an immature market? What are your thoughts around that?
Well, I think you have to distinguish between the CeFi and the DeFi market. So in CeFi, there's a very large cryptocurrency options market. It's quite deep, it's quite liquid. I think trying to implement that in DeFi is extremely difficult.
Okay.
Part of it is the fact that they're also fixed dates. So how do you manage something with a fixed state? Again, we need fixed rates so you can hedge that, time component. Also, having fixed states does mean that you have multiple contracts or multiple instances of the same factory contract because each option has to be its own separate thing. DeFi, we're used to having evergreen contracts that, by definition, are perpetual swaps, perpetual pools. Aave is a standing contract that does variable rates. You can always come in and out and never ends and never there's no beginning, there's no end.
Yeah.
So that's what's easy to program on this blockchain. So as you start having contracts or agreements that have a lifespan, it's a little bit more difficult to build. But I think over time we'll start to see it. But also with the options, I think you're going to need to do some sort of coordination mechanism because you can't have standing liquidity for something with a limited lifespan.
Mm-hmm. Great. I wanted to also get your thoughts around, obviously we've seen Bitcoin EDF. We're essentially seeing the evolution of DeFi like really accelerate before our very eyes. And um, we can sit here and like talk about price and flows and the rest of it, but ultimately, there's no denying that, there is this institutional interest in DeFi and crypto in particular. I actually listened to an interview that Raoul Pal had with Jan van Eck, who obviously from Van Eck Asset Managers he was the one who did the application for his Bitcoin ETF. And it was fascinating to hear like the perspective around like the way that the institutions and particularly they were as Van Eck were looking at crypto. And I was just wondering, where does traditional finance and its participation in crypto and particularly DeFi around interest rates? Do you think it's kind of like, well, they're going to roll with the current like non-fixed interest rate scenario? Or do you think it's almost going to be like a prerequisite that if they are going to come and participate in this market, especially when it comes to lending and borrowing, that they would demand a product like term finance?
Yeah, so you see that in the CeFi lending markets.
Yeah.
Everything there's options. You have open ended, but everybody likes a fixed rate. It's just very hard to trade if you don't know exactly what you're paying or what you're going to earn. So if the CeFi markets are any indication, I think in DeFi we need to be able to enable the same. And again, going back, not to beat on a dead horse, but anything beyond spot markets, so anything that's a derivative, if you want to be able to do fixed dates, you need to have fixed rates.
Yeah. It kind of like, for me, this is a really important ingredient to the story of mass adoption and the execution thereof. Without it, you can't really, you can't get a bunch of serious players sitting at a table trying to justify, like this variation in interest rates from one deal to the next. I just don't think it's going to fly. So I think good on you guys for obviously seeing the importance of that. And I think it's part of the maturity of this market. We need to arrive at that point. If we don't, then it's just going to continue being the Wild West from that perspective. Just coming back to the product itself, I mean, obviously, with the lending and borrowing, there's responsibilities for those who have borrowed to obviously pay back their loans. I mean, I assume that you guys have quite an interesting kind of liquidation process around that within the platform itself. Is that correct? Can you tell us about it?
Yeah, sure. So the liquidation process is actually very similar to Aave and Compound.
Okay.
So we use oracles to monitor the value of the collateral that you've posted. And if the value of that collateral falls below some threshold, then the position or the loan is eligible to be liquidated. The function that executes liquidation is completely public. So anybody, any MEV searcher is eligible to come and call this function to liquidate it. So it utilizes decentralization to ensure prompt liquidations. And one improvement we have made on top of the compound and Aave model is that a borrower's position can only be liquidated to a point where the resulting collateralization ratio returns to our initial margin ratio. So you can't get fully liquidated, only just enough to get you back to some reasonable level of health.
That's awesome. I mean, is it possible for somebody to participate in lending and borrowing without participating in the auction, or do they have to participate, or can they essentially piggyback off the results of an auction from previous?
Yeah, absolutely. So, the lenders receive receipt tokens if they end up being assigned in an auction. And so the idea here is that these lenders can then go and sell these tokens in a secondary market or a
Okay.
listing contract. So now people who don't want to come and wait for an auction, they can just see what's available, what interest rates are available on the market and buy the ERC20 directly rather than have to wait around and participate in the next auction.
Okay, so I think that's probably for me the darling of what it is that you guys have built, honestly. Like, that's awesome because I don't have to wait. I don't have to kind of like participate at that level. I might miss it. I might be taking care of the kids. I don't have a chance to do what I need to do around that. I can step in. Are you finding that people are buying those tokens and then trying to resell them again in a further step in the whole thing, like if you look at the gamification of it, or is it pretty much standard at the moment where tokens are available, they buy it once off, they take out the loan, and that's it? Or is there a market that's developed around this market?
Yeah, for now, the loans have been typically relatively short term. So
Okay.
4 weeks. 4 weeks, most people are fine holding that. There really isn't much need to kind of offload that risk. And I think as a buyer, 4 weeks, you might as well just do floating rate. It's almost the same.
Okay.
So I think that this market will start to bloom and get much more active once longer terms are being minted out of auction. So 3 months, 6 months, out to 1 year. I think that's when it starts getting more interesting. So we'll see how the market develops. I definitely see that as a really interesting and key path of creating, like what we mentioned before, like a yield curve where you have an interest rate for every point in time looking out into the future. So I think that's what really excites us, and
Yeah.
really seeing all the projects that are building out these kind of markets, looking to partner with them.
I know that in terms of the mechanics and the dynamics of the way that you guys have built this, is that liquidity is very much dependent on participants in the auction. But is there an opportunity for you as a platform to also introduce kind of like further liquidity around LP pools where then you participate as a protocol within that auction process as well? And then the protocol itself then also does the lending and borrowing as well as participants.
Sorry, can you repeat that one more time?
So as opposed to, okay, so my understanding is that participants are coming in and they are kind of vying for a lending and borrowing interest rate that they put in the auction. And then that gets matched with somebody on a level of liquidity. So there's obviously kind of like the lender and the borrower gets matched. Is that correct? Or is it a separate process?
Yes, typically multiple lenders and
Yes.
multiple borrowers. And to the extent the prices cross, then they will get matched. It's not always 1-to-1, but it's many to
Okay.
many.
So where does the liquidity come from in terms of the difference between the two, if there is a difference? So for example, if there's more lenders than borrowers in the auction and there isn't a match made, are you guys providing the liquidity in that process? Or is that separate to kind of like the way that the platform works around liquidity.
Yeah, not everybody will get matched,
Yes.
right? So if you're asking for 25%, you're probably going to walk away with nothing. You'll get your tokens
Correct.
back, but you're not going to get matched. So
But
you only match
okay.
what's possible to match, and everybody else, their tokens are kicked back automatically.
Okay, gotcha. So in terms of also the opportunity, like for example with Aave and that, obviously there are liquidity pools. Are you guys provisioning liquidity pools to allow for kind of like more expensive lending and borrowing beyond, people that are participating in the auction?
Yeah, I think for secondary markets, there are multiple ways to do it. One way is through the seaport method, where you
Okay.
just list it and people can trade it like an order book. That methodology does not require any liquidity pools because liquidity pools are very expensive. They're capital intensive.
Okay.
You could potentially have liquidity pools, but the problem there, people have tried before, is that it creates liquidity fragmentation. Each token needs its own separate liquidity pool, and you need something like 10 to 50x the liquidity to support,
Yeah.
$1 of trading. So
Okay.
it's just not really sustainable. But there are models where you can kind of aggregate liquidity. So I think what is likely going to happen in the future is you might have vault tokens. These vault tokens might hold a range of these receipt or repo tokens. And now you only need to find liquidity for that one vault token. And that vault token will then, be eligible for people be able to sell repo tokens into those vault tokens. And these would be kind of like some sort of a money market fund or something like that, a DeFi version of that. Yield vault.
Okay. Makes sense. I mean, is that something that you guys could potentially do in the future, or is it like you'll stick to what it is that you guys are doing at the moment and then just kind of
Yeah, there
scale
are
it out?
actually a lot of versions of this already. We started partnering with other projects who focus on
Yeah.
designing and building vaults. Enzyme is one of those projects. We worked on a project with Yearn. It's not out yet, but we kind of have projects all over, and there's all these vault projects that are coming out every day. And with the new 4626 vault implementation, that's really standardized the vault space. So yeah, you could have various projects providing something similar, for the same product.
Okay, great. When token?
That's hard to say. We're hoping to get it out this year, but don't want to say any specific dates.
Okay.
I'm targeting, around summer is the goal, but you know how deadlines go.
Yeah. I mean, Dion, you don't strike me as the kind of person who's gonna introduce a token in the mix without it having something really significant and a serious role to play. And I mean, just kind of like looking at, without too much detail, I don't want to put you on the spot, but I mean, what purpose would a token in terms of what the product is at the moment? Because when I look at what you guys have done, it seems really complete. You guys seem to have covered all your bases. The mission is, even though it's quite a complex thing to solve, it does read really simple. You've kept it really at its bare minimum, even though there's a lot going on under the hood. How does a token come in and really add value to that equation? I'm just curious how you guys are thinking about it.
Yeah, I mean, I think from our perspective, this is DeFi. It's supposed to be decentralized, and we really want the token, the community, to ultimately be running the protocol, deciding all of the parameters. So from everything down to, what collateral tokens will be accepted, what auctions will be run each week, what the risk parameters will be on those auctions. All of these decisions ultimately being decided by the community and also leveraging sort of the wisdom of the masses to kind of identify new and interesting opportunities and vetting different options week to week. So, and I think that's a key component of that. And in terms of the utility, there's a lot of different things that need to be decided. For example, we can't deploy 50 auctions a week. there has to be a limit. So which ones are those going to be? Should we decide or should we let the market decide? It could be by governance, but also maybe users can stake tokens and say, hey, I'll put my money where my mouth is. I'll put term repo tokens down. If it's a successful auction, I get it back. If the auction's a flop, then you get slashed. A lot of different interesting ways to create, utilize the token and helping to run the system efficiently.
I mean, obviously that's kind of like on the wish list, but what other like wishes do you have? Like when you look at this work that you guys have done, um, since January of last year, where would you like to see term finance, say, in 5 years' time, and what do you envisage, kind of like as the dream for you? What does that look like?
Yeah, I think the dream here is that, you know, term finance will be a place where large volumes of borrow and lend are being matched on a platform on a weekly basis, that it becomes the standard benchmark rate. That rate is a reference rate that will be used across all of DeFi.
Yeah.
And, it'll be a reliable number because there's so much volume behind it that you know that it's real. And hopefully introduces some level of stability. We
Mm.
have seen that protocols like Aave and Compound, the interest rates are super volatile when they start rising. So Aave, you see rates ranging from 5 to 25% on the same day,
Yeah.
on multiple days a week, and this is going on for like the last 3 months.
Yeah.
So you just really don't have a benchmark. And so what we'd like to do is to bring fixed rates to DeFi and hopefully unlock, you know, new layers of the financial stack by creating this term finance yield curve.
So, in terms of the yield curve itself, I mean, is that already kind of like starting to take shape? Is it in existence at the moment? Is it something that we can take a look at now? Or is that still something that kind of needs more data, needs more participation in order to get that?
So you can kind of see like snapshots, where did the 3 month clear, where did the 6 month clear, but the timing it may be staggered. So it's really hard to get a clean, live, synchronous read on that yield curve currently. But I
Yeah.
think that's where ultimately these other projects who are building out secondary markets will start to enable as these tokens become more, um, frequently priced and
Yeah, I
reliable.
think it would be really cool to kind of like just revisit that aspect of what it is that you guys are building into the future and kind of like check what these other protocols have done within kind of their mechanics and what you guys have introduced and kind of reflect upon this discussion. I'd really like to do that into the future and then also maybe also just document that like this is how they approached it, and almost like reflect upon that. How did that work for them? um, it'd be really interesting. I think that's obviously something that um, you know, like you say, like when you engage with Aave and you're seeing 25% interest rates over the course of like a day, it's insane. Like that isn't sustainable. And especially if you are borrowing like a large amount, 6, 7 figures. I mean, that's going to land up hitting your bottom line big time. I think that's probably one of the biggest challenges that DeFi has at the moment. Just in terms of putting this all together, like what have been the biggest challenges that you guys have encountered kind of like along the way in terms of how to conceptualize this whole thing? I mean, have there been major challenges or has it been kind of like pretty straightforward in terms of executing?
The concept at its base, I think, is relatively straightforward, but implementing it specifically on chain in the context of EVM, was a really interesting challenge. So a lot of interesting technical questions, working around the constraints of EVM and Ethereum's or Solidity. It's fun. It's kind of like a puzzle. How do we make this thing fit and work in the right way? Solidity is not the most powerful, flexible language. So you have to get creative in how you do that. So that was certainly fun and interesting while we were building.
I can imagine. In terms of like, obviously, just coming back to, like, until you reach that point where you do become the benchmark, is there kind of like an ambition or a goal to look at what you guys are doing kind of in an omni-chain environment where you essentially allowing your platform to exist in more than one location? Because right now you guys are on mainnet. Is kind of like omni-chain a part of your roadmap?
Yeah, so we actually recently just launched our multi-chain testnet. So you can actually go there now and see what it would look like. Multiple chains all on the same page. We try to unify everything into the same UI. So we're not really distinguishing between chains. It might be on Ethereum, it might be on Binance or Avalanche. From the protocol's perspective, kind of chain agnostic. And hopefully give people an experience where the UI also represents that unified kind of market view.
And what are you guys using as your essentially your Omni protocol?
So right now your tokens are still going to be, you need to have the tokens on the right network.
Okay.
But if you have tokens across various networks, then you can participate in any auction across those networks. In terms of how you bridge those funds, we're not a bridge, so we're kind of bridge agnostic.
Okay. So is there a scenario where you guys could introduce something like Layer 0 and do that process on behalf of customers?
You mean like integrate a bridge directly into the UI?
Correct.
Yeah, that's possible. We could integrate any bridge directly, just like it's more of like a UI thing. It's not really going to be on the protocol level. But yeah, as a UI kind of convenience feature, can offer some simple bridges where they can reduce the number of clicks that they would need to if they wanted to participate on a different chain.
I'm a very big fan of Layer 0. Just actually busy with a bit of a research paper on Layer 0's version 2, and I think that's way ahead of everybody else. I'm probably going to get shot down for saying that on the stream. I'm sure I'm going to get some kind of heat from that, but yeah, I think it's just from an integration perspective, from a dynamic perspective, I think it's by far leagues ahead of everybody else, and they just seem to want to make it better. I think most bridges are kind of set in their way because they're too scared to change things up, and because of security. And Layer 0 in many ways is the opposite. They kind of like, they want to just push the envelope. So maybe that's a consideration, but I really like what they've been doing. Dion, thank you for your time. I think we've covered the basics. I actually understand the protocol a lot better now. I mean, it's different speaking to you versus reading about it. And hopefully, whoever listens to this conversation will get a better understanding. I think, firstly, thank you for your service. I think obviously what you guys are doing is critical to, the maturity of where we're going. I think the institutions have arrived. Like I said, that stream I watched convinced me. And yeah, best of luck. I'm sure we'll chat again. And thank you for joining us. Really appreciate your time.
Thank you for having me on the show, and great questions. So definitely not easy, but I'm glad you asked them, and hopefully everybody has a better understanding now. So thank you for that.
It's a pleasure, Dion. Thanks a lot. Everyone, please like and subscribe. Keeps things interesting, and it keeps the algos going. Take it easy until next time. Thanks for joining us.